Welcome back to the deep dive. Today we're unpacking a really fascinating contradiction, something straight from the world of institutional finance. We're focusing on Euronet Worldwide, that's ticker EEFTA, uh, a massive global player in the electronic payments ecosystem.
Right.
And the story here starts with a very clear market signal. Pessimism. Euronet stock has been in the doghouse.
To put it mildly.
It's down a staggering 24.6% over the last year. And at the same time, the S&P 500 has surged roughly 17%. So if you just glanced at the stock chart, you'd think this company was facing some kind of imminent crisis.
Absolutely. The chart looks terrible.
But then you look behind that chart and you find money moving in, specifically sophisticated, patient institutional money. Our sources detail a recent disclosure showing that Value Holdings Management, a highly respected New York-based fund, just bought a significant chunk of shares.
And how much are we talking about?
An estimated $7.66 million worth. And this wasn't just, a maintenance buy. This was a purposeful addition to their portfolio.
Okay, so that's a real signal.
Exactly. So you have the market punishing the stock and a serious institutional fund committing millions. The central question for this deep dive is pretty simple. What core operational durability does Value Holdings see here that the rest of the market is just missing? Let's figure out what's hiding beneath the surface.
This is a classic case. This is exactly what separates long-term value investing from, just trading the headlines.
Right.
When you see a major fund moving against such strong negative market sentiment, they aren't speculating on a quick price reversal. They're doing a deep fundamental evaluation. This isn't about momentum, all that price noise. It's about durability, the underlying health and structure of the business itself. So before we can even assess their thesis, we have to truly understand the operational foundation of EFT.
Agreed. So let's start right there. Let's get into the basics of what Euronet actually does. For listeners who aren't, constantly immersed in global financial infrastructure, paint us a picture. We know they do electronic payments, but what does that actually look like? How does that translate into revenue?
Okay, so think of Euronet Worldwide as the global utility company for cash.
The plumbing.
The plumbing, exactly. They are the essential and often invisible pipes that allow money and transactions to flow across borders and through physical locations all over the world. You don't think about your water pipes until they burst.
Right.
But you rely on them every single day. EFT is kind of like that boring maybe, but absolutely essential.
I like that analogy.
And what's crucial here is their scale and their business structure. This isn't just one service line, it's highly diversified. They operate a massive global footprint across electronic payments and transaction processing.
What does that infrastructure include?
It includes running over 50,000 ATMs, hundreds of thousands of POS terminals, and operating money transfer locations.
50,000 ATMs. Wow, that sounds like an enormous logistical challenge. What's the barrier to entry there? Couldn't a huge tech company just build a competing network?
You'd think so, but it's far harder than it looks. Building a global physical network of 50,000 ATMs and then ensuring compliance with hundreds of different financial regulators globally.
Ah, the regulatory headache.
Exactly. That creates a significant operational moat. Their revenue is generated through dependable fee-based streams. Transaction fees every time someone uses an ATM or POS, outsourcing fees from banks, commissions from money transfers. They aren't reliant on selling some shiny new gadget.
It's all about necessity.
It's all about the fundamental necessity of cash and cross-border payments. It's a very, very resilient revenue foundation.
That's a great framing. Okay, so we have a diversified, infrastructure-heavy business that generates reliable, repetitive fee revenue, but the market still views it as toxic, cutting its value by a quarter in a year. Let's look at the institutional behavior now. How did Value Holdings make its move?
Let's get into the specifics.
The specifics of the trade, straight from the SEC 13F filing, are this. Value Holdings Management purchased 98,289 shares of EEFT in the fourth quarter. And based on the average quarterly pricing, that's where we get that $7.66 million value we cited earlier.
Okay.
Now let's just clarify some jargon for you if you're learning quickly. The 13F is that quarterly disclosure institutional investors have to file. This particular purchase brings their total allocation in Euronet up to 2.5% of the fund's total AUM assets under management.
Which is the total value of all the holdings they report.
Correct. And 2.5% is a measurable strategic position. It's not just a rounding error.
And context is everything for that 2.5%. If Value Holdings was, say, a fund known for taking aggressive outsized bets on distressed companies, 2.5% might look like a small speculative position.
But that's not them.
That is not them. If we analyze Value Holdings' core philosophy, we see a very clear pattern. If you look at their existing portfolio, their top 5 holdings companies like EME, construction giant, ROL, specialty services firm, WAB, a railroad equipment supplier.
All very unsexy foundational businesses.
Exactly. Those positions are allocated between 8% and 10.2% of their AUM. These are not headline-grabbing high-growth tech unicorns. They are industrials and recurring revenue operators built around operational leverage.
So their entire philosophy is reliability and consistency over explosive volatility.
That's it. They are value buyers who prioritize consistency above all else. When they allocate significant capital, they're looking for reliable cash flow that can compound through economic cycles. The fact that EFT is now integrated into this reliability-focused portfolio tells us they view Euronet as a durable operational machine. It slots perfectly alongside utilities and infrastructure providers, despite this temporary price drop.
That frames the motivation beautifully. This is a long-term strategic addition, not a quick flip.
Right.
But now we absolutely have to tackle the elephant in the room. Section 3, the performance paradox. Why the huge disconnect?
This is the key question.
We mentioned the stock is down 24.6%, trading recently around $74.03. Now let's contrast that market fear with the fundamental size of the company. We pulled the trailing 12 months, or TTM financial snapshot.
TTM just meaning the last 4 quarters combined.
Exactly. And here's where it gets really interesting. Our sources show $4.18 billion in revenue
Okay.
and $304.30 million in net income. But the entire company's market capitalization, its total value on the stock market, is only $3.03 billion.
Wait, run that by me again?
Over $4 billion in revenue, and the whole company is valued at just over $3 billion.
Wow. So it's trading at less than 1 times its annual sales.
Yes. How is a massive established global company generating more revenue in a year than the entire market values the company at? That sounds deeply lopsided.
It is a profound imbalance, and it signals that the market is currently pricing in disaster risk, or at least extreme stagnation, that is just completely disproportionate to the actual performance. When you see a valuation that low relative to revenues and net income, a value investor immediately flags that as a potential opportunity.
And the most recent quarterly results just reinforce this. The stock is signaling distress, but the operations are signaling health.
What do those numbers look like?
Revenue climbed 4% year over year to $1.15 billion. Operating income increased 7%. Adjusted EBITDA rose 8%.
All solid.
But the headline number, the one Value Holdings is likely really focused on, is the adjusted earnings per share. That jumped a whopping 19% to $3.62.
19% in this macro environment.
A 19% jump in earnings per share suggests massive efficiency gains or strong pricing power, or maybe both. The operational engine is clearly accelerating, yet the market is hitting the brakes.
Precisely. And the safety net here is enormous. Let's look at the balance sheet context. This business is just generating cash at scale. Euronet reported ending the quarter with over $1.1 billion in unrestricted cash, just sitting on their balance sheet.
$1 billion in cash.
$1 billion in cash. And beyond that, they have access to roughly $1.8 billion in revolving credit capacity.
So no liquidity concerns.
For a value investor, this means the risk of financial stress, a liquidity crisis, or bankruptcy is virtually zero. They have massive financial flexibility. The market is worried about macro factors. The institutional buyer sees a deep discount on a structurally sound company with a fortress balance sheet.
But wait, let me push back on that for a second. If this is truly such a lopsided bargain and the balance sheet is a fortress, why is Value Holdings only allocating 2.5% of their AUM?
That's a fair question.
If it's a slam dunk value trade, shouldn't they be putting 10% or 15% into it? Doesn't 2.5% feel a little like a cautious toe in the water, not a full conviction buy?
It's a necessary, critical question. And the 2.5% allocation does suggest a measured entry, not necessarily full throttle conviction yet. They likely view this as building a core position, but the allocation size may reflect some of the acknowledged risks, which we'll get to in a minute, or simply the fact that they're scaling into the position gradually.
Okay, that makes sense.
However, the signal remains strong. They're willing to put over $7.5 million against the prevailing negative sentiment. It signals confidence in earnings durability over price momentum. Value Holdings isn't looking for a quick 50% jump. They're looking for a reliable, fee-generating business that's undervalued because of temporary macro noise.
They trust that 19% EPS jump.
They trust it proves the core business model works. regardless of what the headlines say. It confirms that the stock's underperformance is being interpreted as market pressure and some uneven segment growth, not a structural failure of the business.
And even with that unevenness, the micro successes are still there.
Absolutely not. The fundamental drivers are still positive. The sources confirm that the EFT processing volumes, the actual number of transactions through those 50,000 ATMs, and their digital money transfer volumes continue to expand.
So the engine is healthy.
The engine is healthy even if the road ahead looks a little bumpy.
Okay, let's shift our focus to that road ahead. Section 5. The forward look and the critical caveats. We know management acknowledged that uneven performance. What is their current projection?
Despite the recent headwinds, management remains quite optimistic about the medium term. They've reiterated a robust expectation for full-year adjusted EPS growth, targeting a range of 12% to 16%.
Wow, 12 to 16%. That is substantial growth for a company of this maturity and size.
It really is.
But for a global payments company, there are always uncontrollable macro forces at play. What are the major risks that temper that optimism?
And management was very clear about this. This is a critical point for you, the listener. They explicitly warned that unforeseen macro factors, particularly foreign exchange or FX rates or general interest rates, could significantly impact that outlook.
Okay, let's break that down. FX risk first.
Because Euronet facilitates cross-border payments money moving between countries, they're constantly dealing with different currencies. Any sudden fluctuation in those FX rates creates currency translation risk, regulatory risk, and potentially hedging costs that can eat into their profit margins very quickly.
So, if the dollar strengthens unexpectedly against the euro or a basket of emerging market currencies where they operate, those transaction fees suddenly translate back into fewer U.S. dollars.
Exactly. It makes their revenue look smaller, even if the underlying transaction volume hasn't changed at all. It's a volatile variable completely outside their control.
And the interest rate risk.
Now, you layer on interest rate risk. High interest rates can impact the global economy, slowing down cross-border travel or remittances, which is where Euronet makes its money. Plus, the cost of capital, even with a big cash reserve, affects the value of that $1.1 billion they hold and the cost of maintaining their credit facilities.
So we've got a company with a durable fee-based model, huge cash reserves, and a 19% recent EPS jump. But all of it is riding on the stability of global currency and interest rate markets.
That's the tightrope.
So to wrap this up, let's bring it back to the big picture for you, the learner. This deep dive beautifully illustrates the crucial gap between market sentiment, which is heavily influenced by short-term momentum, and fundamental operational health.
Which is what Value Holdings is focused on.
We've seen how savvy institutional investors define value. They are ignoring the 25% price drop and instead focusing on that operational leverage and fee durability. They are willing to stomach the negative sentiment because they trust the balance sheet and the essential nature of the business model.
And that leads us to the final necessary question that really builds on all this material. We've established the confidence in Euronet's operational durability and that impressive 12 to 16% EPS growth target. But we also know that macro forces, interest rates, and foreign exchange rates cast a huge shadow over all global payments businesses.
A very long shadow.
So the question for you to mull over is this. Considering the current geopolitical and monetary volatility, at what threshold does uneven segment growth, which the market is punishing now, become less about temporary macro noise and more about a fundamental, longer-term structural challenge, a challenge that even Euronet's billion-dollar cash reserves might not be enough to smooth over? That's the risk-reward calculation being made right now.
A fascinating balance to strike. The deep dive is complete, but the analysis is just beginning. Go explore those source materials further, connect those macro dots, and we'll catch you on the next deep dive.